Okay, so just think about the tech you've probably already touched today. Your email, maybe a spreadsheet, even, I don't know, a quick game, perhaps.
Mhm.
Chances are really, really high that Microsoft was involved somewhere in there. I mean, this company, it's not just some tech giant. It's, well, a $2.83 trillion behemoth as of April 2025.
Yeah.
Deeply, deeply embedded in how we work and play.
That number, $2.83 trillion, it's just staggering, isn't it? It really hammers home how pervasive Microsoft has become across, well, the entire global tech landscape.
Exactly.
Makes you really stop and think, what is driving that kind of massive valuation?
Exactly. And that's precisely the mission for us today in this deep dive. We've pulled together, a whole range of sources, all current as of April 11th, 2025. We're talking analyst reports, the actual financial statements, the latest market buzz,
Right.
to really try and dissect what's fueling Microsoft's engine, understand its financial health, its position. We want you, our listener, to get a genuine feel for what's happening beneath the headlines.
Yeah, our aim isn't just to list facts. It's about connecting those dots, hopefully revealing some maybe surprising insights along the way.
Right.
So you walk away with a richer picture than you'd get just skimming the news.
Absolutely. And to make sure we cover all the bases without, getting lost in the weeds, we've broken it down into 6 key areas. First up, business understanding. Then we'll look at management. Third, a dive into financial health.
Okay.
Then in the second half, we'll gauge market sentiment, check out the ownership structure, and finally do a risk assessment using a SWOT analysis. So yeah, buckle up. It should be a fascinating journey. Let's kick things off with Chapter 1, business understanding. Fundamentally, what does Microsoft do?
Well, at its heart, Microsoft is a global tech company. They develop, they license, and they support this incredibly wide range of software products, services, devices, and, broader solutions. Their official mission, to empower every person and every organization on the planet to achieve more.
That mission statement really does capture the scale of their ambition, doesn't it?
It does.
And if we look at where their revenue actually came from in fiscal 24, a huge $245.1 billion, it splits into 3 main buckets. The biggest one, just shy of 40% at $97.7 billion, is intelligent cloud.
Right. The powerhouse.
Yeah, this is home to Azure, their massive cloud platform, but also things like SQL Server, Windows Server, GitHub, and their enterprise services. It's the giant in the room now.
It's really quite something how cloud has just become the absolute core, the main engine for Microsoft. It's not just part of the business anymore.
Not at all. Then the second chunk, productivity and business processes. That brings in about 32%, so $78.4 billion. This is where you find Microsoft 365, Word, Excel, Teams, all that stuff for both businesses and us regular consumers.
The stuff everyone uses daily.
Pretty much. Plus, LinkedIn is in here, the professional network, and their Dynamics 365 business application. Think how many companies rely on this stuff. It shows how sticky their ecosystem is.
Yeah, that segment really highlights their strength in providing those, foundational tools, the things individuals and companies just need for daily operations, communication, managing the business.
Right. And the last piece is more personal computing. This was about 28% of revenue, $69 billion. It's a bit more of a mix. You've got Windows licenses for PC makers, and businesses, their Surface devices, the whole Xbox gaming world.
Which now includes Activision Blizzard, a huge addition.
A massive addition, yeah. And even Bing advertising revenue falls in here. So yeah, from your work laptop to your console, they're likely there.
And that segment really shows how they've successfully diversified, beyond just being the Windows company of the past. They're hitting consumers at so many different points in their digital lives now.
And that diversification is critical. It's not all about the PC anymore. Like in FY24, their device revenue dipped a bit, but it was more than offset by really strong growth in cloud and also in gaming. That balance provides a really important buffer if one area hits a speed bump.
Precisely.
Yeah.
And just think about the sheer breadth of what they offer. You've got the OS with Windows, the productivity stuff with M365, the huge Azure cloud platform, Dynamics 365 for business apps, LinkedIn for networking, Xbox for gaming, Surface for hardware, Bing for search, developer tools like GitHub.
Security solutions, too, increasingly vital.
Absolutely. And now, layered across almost everything is AI through Copilot. That's becoming central.
And what's striking is in most of these core markets, they're not just, in the market. They're often the leader, number 1, or a very strong number 2.
Yeah.
That kind of dominance is a massive advantage.
Their core value proposition really seems to be this incredibly interconnected ecosystem. Solutions for productivity, digital transformation, professional networking, entertainment, and now increasingly unified by AI, especially with Copilot getting woven into so many products.
Okay, and here's where it gets really clever, strategically.
Yeah,
By embedding Copilot into products people already use massively, like Office or Windows,
right.
they're basically turbocharging AI adoption using their existing user base and creating totally new ways to make money, like selling premium Copilot features. It's a smart play on their existing strengths.
Definitely. Now, stepping back a bit, we should probably look at the industries themselves. Are cloud, software, AI, gaming, are these fundamentally healthy, growing markets for the long haul?
Oh, absolutely. These aren't just trends. They're fundamental pillars of the modern economy, aren't they? The whole digital transformation thing isn't slowing down, which means sustained, growing demand for exactly these kinds of technologies.
And the specific trends within these markets look pretty strong too. Cloud spending, for instance, is expected to jump again significantly in 2025, and Azure keeps eating into market share.
Right. And AI, I mean, the potential there is just explosive. Microsoft themselves said their AI services hit an annualized run rate over $13 billion in early 2025. That's incredible momentum.
Phenomenal. And gaming keeps growing globally, helped by better internet access, diverse content now amplified by Activision Blizzard, and things like cloud gaming.
Yep. Enterprise software like Dynamics 365 is also growing steadily as businesses optimize. And cybersecurity. Well, with threats constantly evolving, spending there is booming, which is great for Microsoft's security offerings.
But of course, attractive markets mean fierce competition.
Mm-hmm.
In cloud, you've got AWS still leading, and Google Cloud is a very strong player.
Definitely.
Productivity, Google Workspace, Salesforce, Apple dominates its own OS space. Gaming, you've got Sony and Nintendo as huge rivals, and AI is crowded, Google, Amazon again, NVIDIA for hardware, loads of startups.
It's a battlefield. And it's not just market competition. The regulatory side is becoming a much bigger deal too, isn't it?
Absolutely. We're seeing more antitrust focus, like the EU looking into teams bundled with Office or their OpenAI partnership. Then there's data privacy like GDPR, U.S. state laws, cybersecurity standards getting stricter, AI governance rules starting to form.
And even trade policy, like those 2025 U.S. tariffs impacting hardware costs.
Right. And the thing about these regulatory actions is they're not just about potential fines. They could actually force changes to how Microsoft operates, particularly that integrated ecosystem we talked about. Imagine being forced to unbundle teams or limit AI integration that could hit them hard.
That's really key risk. And thinking about new players trying to enter these markets, the barriers are just huge. Building a global cloud like Azure, massive, massive upfront cost.
Astronomical.
OS and productivity software, the network effects are so strong, and switching is a nightmare for users.
Yeah.
Gaming consoles, huge R&D, constant content needed. Enterprise software, you need deep industry knowledge, integration skills.
And now there's this almost an arms race in spending just on AI infrastructure to stay competitive. It's incredibly capital intensive.
So given all that context, let's talk about Microsoft's competitive advantage, that economic moat. What really protects them?
Well, it's not just one thing, is it? It's like multiple layers. First, just the sheer brand strength. Microsoft, Windows, Office, Azure, Xbox, these are globally recognized, especially in business. That trust is invaluable.
True.
Then you have major cost advantages, economies of scale, especially with Azure. Running that massive global cloud operation lets them offer services cheaper per unit than smaller guys. Their global R&D, sales, marketing networks also benefit from that scale.
And the network effects are just incredibly powerful. Think Windows and Office, the more people use them, the more developers build for them, making them even stronger.
Right. Teams gets better with more users. LinkedIn is more useful with more professionals. Xbox Live, Game Pass, same idea. Even the Azure Marketplace benefits from more partners and more customers. It feeds itself.
We also can't ignore the switching costs.
Yep.
For big companies especially, moving away from that integrated Microsoft stack, Windows Server, M365, Azure, Dynamics, it's hugely disruptive, expensive, complex. User training, data migration, legacy systems, it locks them in.
Definitely. And finally, they just have unique assets and capabilities that are hard to replicate. Their IP portfolio, the Azure infrastructure itself, the vast data they can access for AI training from Bing, LinkedIn, M365.
Their deep enterprise relationships built over decades.
Exactly. Their leadership in hybrid cloud with Azure Arc, and of course their AI expertise, boosted by that OpenAI partnership. That's a major differentiator right now.
And what ties it all together, maybe the hardest thing for competitors to copy, is that synergy between their enterprise and consumer businesses. Strength in one often boosts the other. It's a powerful feedback loop.
It really is. It creates a very durable moat.
Okay, solid understanding of the business now. Let's pivot to chapter 2. Management evaluation. How's the leadership looking? Are they steering this massive ship effectively, ethically, for the shareholders?
Well, the general view on Satya Nadella, CEO since 2014, chairman since 2021, is overwhelmingly positive. He's widely seen as honest, very capable, and definitely focused on shareholder value.
His track record is pretty undeniable, isn't it? He oversaw that huge shift to cloud and now AI. Azure's growth under him has been, well, transformative.
Absolutely. And he's credited with changing the culture, too, making it more open, collaborative. Plus, those big strategic acquisitions, LinkedIn, GitHub, now Activision Blizzard, happened on his watch.
And for shareholders, the stock price basically went up nearly tenfold between 2014 and late 2023. That's remarkable.
Phenomenal return. He gets a lot of industry recognition, too, which usually reflects strong leadership.
And it feels like his approach is quite pragmatic. Focus on core strengths, but use acquisitions or partnerships smartly to fill gaps or jump into new areas.
Yeah, that seems fair. Looking at how they handle crises, they appear pretty proactive, especially cybersecurity. They seem quick to patch things, address vulnerabilities. They also seem to have learned from past antitrust battles, engaging more maybe constructively with regulators now.
And workplace issues.
They've publicly acknowledged issues and outlined steps to address them, showing some responsiveness there too.
Communication-wise, seems fairly standard for a big public company. Earnings calls, reports, investor website.
Yeah, pretty standard. They do provide guidance, though sometimes it's seen as a bit cautious, which can occasionally, temper market excitement short term.
What about the ethical reputation?
Generally, they project a responsible image, talking a lot about trustworthy AI and things like that. But like any company that big and powerful, they face constant scrutiny over market dominance, security vulnerabilities, workforce diversity. It's ongoing.
But purely from a shareholder perspective, actions seem aligned.
Very much so, I'd say. Decades of consistent growing dividends, big share buyback programs, that huge long-term stock appreciation we mentioned, and their return on invested capital is consistently strong, which suggests they're using shareholder money effectively. So overall, yeah, competent strategic leadership aligned with long-term shareholder interests seems like a fair assessment.
Okay, that leads us nicely into Chapter 3, Financial Health. Let's crunch some numbers and see how solid the foundations are as of mid-April 2025.
All right. So key metrics. Market cap, as you said, a huge $2.83 trillion. Share price around $381.35. That gives a PE ratio of roughly 31.
Which feels a bit high, maybe.
It's certainly not cheap. But let's look at the other numbers. FY24 revenue growth was strong at 16%. Gross margins around 69%. Operating margin about 45%, very profitable.
Wow, those are impressive margins.
They really are. Net profit margin around 35%. And their balance sheet looks very strong. Debt to equity is super low, about 0.17.
Very conservative on debt, then.
Extremely. Free cash flow in FY24 was massive, $74 billion. Price to book is high, around 9.6 times, again reflecting that premium valuation. But return on equity is robust at 38%, and ROIC is excellent, somewhere between 22.5% and 30.1%.
So the valuation suggests the market expects a lot, likely banking on continued dominance and successful AI monetization. The forward PEG ratio is around 2, so growth expectations are baked in. But the quality and market position might justify it for some. And looking longer term, has this strength been consistent? Like earnings stability?
Yes, generally. Earnings per share have shown strong, pretty consistent growth over the last 5-10 years. Roughly 20% CAGR over 5 years, maybe 16% over 10. There was a bit of a slowdown in FY23, but things picked back up strongly in FY24.
And dividends, you mentioned those earlier.
Exemplary record there. Consistent quarterly payments, annual increases for over 20 years now, but a 10% growth rate over the last 5 years. And the payout ratio is quite conservative, around 25%, so plenty of room for future increases.
Wait, debt management sounds very prudent, too.
Very low and declining debt to equity. Minimal long-term debt compared to equity or cash flow. Top-tier credit ratings. They have used debt strategically in the past, like around the LinkedIn deal, but paid it down quickly. They clearly value financial flexibility.
And working capital, managing day-to-day cash flow efficiently.
Seems so. Strong liquidity ratios. Reported current ratio 1.77. Quick ratio 1.75 as of June 2023. And their huge cash flow generation points to efficient management. So, yeah, overall financial health looks exceptionally strong. Very solid base. Podcast host, mid-roll ad break.
All right, before we dive into the second half, where we'll be covering market sentiment, ownership structure, and risk assessment, let's take a quick moment to tell you about a tool that could help you gain insights just like this on demand. Imagine being able to generate comprehensive reports, insightful podcasts, or detailed video analyses on any stock whenever you need it. What if you could customize the depth of that analysis to perfectly match your existing financial knowledge and the specific areas you want to explore? At stockanalytics.ai, we're building exactly that capability. But we're going even further by adding an interactive interface where you can ask specific questions about any stock, a voice-controlled stock screener to quickly identify opportunities, and a powerful portfolio analyzer to help you de-risk and stress test your investment holdings. Ready to experience the future of financial intelligence? Visit stockanalytics.ai today. Take a look at our demo to see it in action. We've now opened the waiting list for our beta users, and for a limited time, we're offering 50% discounts on early access and even potential opportunities to invest in the future of stockanalytics.ai itself. Don't miss out. Sign up now at stockanalytics.ai. And now, let's get back to our deep dive into Microsoft with Part 2.
Welcome back. We're now moving into Chapter 4, Market Sentiment. So, how's the market actually feeling about Microsoft stock right now?
It feels like generally positive, but with a definite layer of caution maybe. It's seen as this high-quality foundational company, strong in cloud, strong in AI, a core holding for many.
Yeah.
But the stock has pulled back from its 2024 highs. That suggests there are worries floating around about the macroeconomy, those tariffs we mentioned, and maybe the sheer amount they're spending on AI right now.
The CapEx question.
Exactly. Some analysts are even saying it might trade sideways for a bit, sort of range-bound, until the cloud revenue growth really clearly starts outpacing those big AI investments.
Interesting. But what about the Wall Street analysts themselves, their price targets?
Well, they are still overwhelmingly bullish. The consensus is generally strong buy or moderate buy. The average 12-month target is hovering somewhere around $500 to $510.
Wow, that's quite a premium to where it's trading now. Over 30% upside implied.
Yeah, significant. You see specific targets like Stifel at $475 buy, Piper Sandler $520 overweight, Morgan Stanley $500 strong buy.
So there's a real tension there, isn't there, between the analysts focusing on that long-term AI potential and maybe the broader market pricing in more of the near-term risks and uncertainties.
Exactly. And recent news has definitely influenced sentiment. Those U.S. tariffs that created volatility, worries about hardware costs, data center gear. Remember that Ohio data center cancellation?
Yep.
That got linked partly to tariff costs.
Right, a negative impact.
But then on the plus side, you have this strong AI momentum, that $13 billion plus run rate in Azure AI. That's positive.
Okay.
Earnings have been a bit mixed in terms of reaction, strong FY24 overall, but the guidance for Q3 FY25 was maybe a little weaker than hoped, which seemed to pressure the stock. Upcoming earnings could be a catalyst, though.
What about negative news? Any recent issues?
Well, there have been reports about cybersecurity stuff like actively exploited zero-day vulnerabilities, CVE 2025-29824 was mentioned. That always makes the market a bit nervous. And of course, the ongoing antitrust scrutiny is always a background negative factor.
Okay, and what about short interest? Are many people actively betting against the stock?
Actually, no, it's really low, typically around 0.87% to 0.9% of the float. Days to cover is also low, like 3 days. And the cost to borrow shares for shorting is low, too.
So not much bearish pressure from short sellers.
Doesn't look like it. While we don't track options activity in detail here, that low short interest is a pretty strong signal that sentiment isn't heavily negative among that group.
Okay, let's shift gears then to Chapter 5, ownership structure. Who actually owns Microsoft?
Well, it's overwhelmingly institutions. We're talking somewhere between 72% and 74% institutional ownership. It's dominated by the really big asset managers, the index fund giants.
Vanguard, BlackRock, State Street.
Exactly. They're always the top holders. Fidelity Capital Research, too. And mutual funds and ETFs together probably hold around 40% of the company.
So huge confidence from the big money managers, but also means it's heavily influenced by index fund flows, right? If money moves into or out of the S&P 500, Microsoft moves with it, regardless of company specifics sometimes.
That's a very good point. What about insiders, executives, board members?
If you exclude the big legacy stakes, Bill Gates and Steve Ballmer, the direct ownership by current management and the board is actually tiny, like 0.03%.
That low?
Yeah. Now, if you add Gates' stake, which is still around 1.4%, and Ballmer's about 4.5%, then total insider ownership gets up to around 6%. Current execs obviously hold a lot via compensation,
But
but
not much recent open market buying.
exactly. That's something value investors often look for, and you don't really see significant recent buying from the current team. Selling via preset plans happens, sure, for diversification or whatever, but not much buying.
Interesting. So ownership is pretty spread out among those big institutions then. No single controlling entity apart from maybe those legacy stakes.
Right. No external holder has more than 10%. And Gates and Ballmer aren't acting as a controlling block. It suggests the company's interests are likely aligned with that broad institutional base.
And how does that impact governance? Seems pretty standard for a huge U.S. company.
Yeah, pretty standard. Diverse board. Nadella is both chairman and CEO, which is common in tech but sometimes gets flagged. But with such high institutional ownership, there's a built-in accountability mechanism. Executive pay is tied to performance, regular shareholder communication. It ticks the usual boxes.
All right, final main chapter before we wrap up. Chapter 6, risk assessment. Let's use that SWOT framework. Strengths, weaknesses, opportunities, threats.
Okay, strengths first. We've touched on many. Dominant market share in key areas, powerful brand, diverse revenues, that integrated ecosystem with high switching costs.
Massive scale, financial strength, Nadella's leadership, AI capabilities boosted by OpenAI, that huge partner network.
Exactly. Weaknesses. Maybe a lingering perception, though fading, of lagging in innovation, sometimes historically.
Right.
Mobile browsers. Still some dependency on the PC cycle. Being a prime target for cyber attacks is a weakness in itself.
Complexity of such a huge organization. Bureaucracy risk.
Yeah, that's fair. Some past M&A didn't pan out perfectly. And the ongoing regulatory heat is definitely a factor.
Opportunities seem huge, though. Monetizing AI like Copilot and Azure AI services has got to be top of the list.
For sure. Continued Azure growth, grabbing more market share, expanding gaming with Activision and cloud gaming, growth in enterprise software, cybersecurity.
Expanding in emerging markets, new partnerships, even looking way out, things like quantum computing.
All potential opportunities, yes. And finally, threats. Intense competition everywhere. That regulatory and antitrust pressure we keep mentioning, it's significant.
Cybersecurity attacks are a constant threat. Macroeconomic slowdowns hitting IT spend, the risk of some new technology just disrupting everything.
Those 2025 U.S. tariffs specifically. Execution risk, can they really deliver on AI monetization? Integrate Activision smoothly, get returns on that massive CapEx, and even competition from open source software.
Let's zero in on those tariffs for a second. We mentioned them a few times. What's the real impact?
Right. So these tariffs hit goods from China and other key Asian manufacturing hubs. For Microsoft, that means higher costs for hardware Surface, Xbox consoles, because so many components come from there.
And they've actually complained publicly about this, right? Along with Sony and Nintendo.
They have voiced concerns about the impact on the gaming sector especially, but it's broader than just the product cost. It forces supply chain adjustments, maybe stockpiling, looking for factories elsewhere, possibly using more expensive air freight.
And it hits their data center costs, too. Servers, networking gear.
Yes, absolutely. That Ohio data center cancellation was partly blamed on rising equipment costs due to tariffs. It puts pressure on their CapEx budget for Azure expansion.
So higher costs could mean higher prices for consumers, potentially hurting demand. Plus, just general economic uncertainty may be slowing down IT spending overall.
That's the worry.
Yeah.
They are trying to mitigate it, diversifying supply chains, stockpiling, looking at alternative manufacturing, using trade deals like USMCA. But undeniably, the tariffs are a real headwind, hitting hardware profits and maybe cloud CapEx.
Okay. And beyond tariffs, the other big risks seem to be that constant cybersecurity threat, the regulatory pressure potentially forcing business model changes, intense competition, technological disruption, just executing on AI and Activision, and general economic sensitivity.
That sums up the key risk areas pretty well, I think.
Okay, so let's try and pull this all together now in Chapter 7, our conclusion. What's the big picture?
Well, Microsoft is clearly a dominant tech powerhouse. It has that incredibly wide economic moat, really capable leadership under Nadella, and just exceptional financial strength. But it's also facing some pretty significant headwinds and risks. Those tariffs, the regulatory scrutiny, fierce competition, and the very real challenge of executing perfectly on these huge bets in AI and gaming integration.
And the valuation, where does that leave us? At around $381?
Yeah, it does seem full. PE in the low 30s, price to book near 10. Free cash flow yield is relatively modest. It feels like the market is pricing in a lot of future success, especially from cloud and AI. Not much margin of safety baked in, despite the undeniable quality.
So you have that split. Again, analysts super bullish on the long term, market may be a bit more cautious right now.
Seems that way.
So from a value perspective, what's the takeaway?
It's a fantastic business, no doubt. The arguments for investing are strong. Quality, moat, leadership, financials, huge growth potential in cloud AI. A pullback could definitely be an attractive entry point.
But the arguments against at this price.
The full valuation offers little downside protection. Those risks, tariffs, regulation, execution are real. And maybe that lack of recent insider buying gives some pause. So while it's an exceptional company, this specific price might not scream value with a clear discount. Maybe patience for a better entry point is warranted for value-focused investors.
Makes sense. A balancing act.
Indeed. And maybe here's a final thought, a question for our listeners to chew on. Given how fast AI is moving, how might Microsoft's competitive landscape, even its economic moat, actually look different in, say, 5 or 10 years? And what signs, what indicators should you be watching closely to track that evolution?
That's a great question to ponder. Really gets you thinking about the long game. And if you found this kind of deep dive helpful and want more analysis like this, definitely subscribe to the Stock Analytics AI YouTube channel.
And finally, just our standard but very important disclaimer. Please remember, this analysis is based on information available as of April 11th, 2025. Financial markets move fast, things change.
And we should also mention that AI was used in putting together some of the analysis and presentation here today.
Critically, none of this is financial advice. It's purely for informational purposes.
Oh.
Always do your own thorough research, and please consult with a qualified financial advisor before making any investment decisions.
Okay,